Let's get 3 minutes on the markets then with Mark this morning. And Mark, where do we want to start? Because we've got European stocks and US stocks called a little lower. It's easy, as we have done in recent days, to pin this on trade. There have been some kind of negative trade headlines around pharma, but there's also the ASML numbers, which are a little tentative when we look ahead for the third quarter. I wonder what you think is most likely weighing on sentiment this morning.
I think there's two things. I think that the narrative on trade is changing. I have to say, I find how investors are talking about trade very confusing. I'm seeing a lot of people going, "Oh, maybe Trump won't ultimately back out of everything." I don't know why anyone ever thought that there was never going to be high levels of tariffs. One of the most consistent things of Trump's political career has been his love of tariffs. And he, you know, when he wasn't president, in the interim phase, he constantly talked about his regret that he did not impose more tariffs, and he was very clear that that's what he wants. You know, we did the interview last July before he got nominated. Bloomberg did the interview, and the thing he kept him going back to is he loves tariffs. He thinks they're just the best tool in the world, even when he wasn't prompted. And so, of course, we're always going to get tariffs. We just don't know what levels and against who. And I'm finding it weird that investors still don't really believe that. And I think that they're still coming to a shock on August 1st. And as we get closer, they're starting to price it in. So that's a big dynamic. The fact is, though, there's another big dynamic out here, is that government debt sustainability is really, really back in focus across the world. And the whole point is it's not just one region, not just the Eurozone debt crisis. It's not just, you know, UK, where it's everywhere at once. It's US, Japan, UK, Europe. It's all the developed markets at once. And it's really problematic. Just to do a quick plug, our colleague Simon White just did the most amazing column yesterday on this, just saying, you know, a developed market bond crisis is now a serious possibility.
Maybe we should just all give everybody a pass and start over from scratch. I think it's crucial, though, that you're mentioning this trade story, because there's also a question of what is actually cost prohibitive here. If we say 30% on the European Union, how much of an impact does that actually make on the end product, especially if the focus is on the deficit and the idea is that the revenue would plug the deficit? Is that a viable thought that this world can digest 30%, 50% tariffs?
I mean, ultimately, of course, we always judge for, you know, humans are innovative and they find new solutions. It's what those solutions will be. But it's going to be extremely problematic. And what level depends on which country and which products. And that's the point, is I think it's going to be very hard to trade, because it's going to feed through in different industries and services at different rates and in different countries at different times. Which is not, there's not a binary tariff shock moment, which is what I think people are trying to trade, both in the inflation data and business. Ultimately, though, what we're going to see more of is companies are just going to, after 80 years of just getting your supply chain as heavily invested in the US as possible, because it was both the best framework for doing business, for legal side, for policy certainty, and for the consumer. The coming years are just going to be getting your supply chain out of the US. This is ultimately just going to be increasingly more expensive for US businesses to do business, and it's going to be increasingly more expensive for US consumers, because the rest of the world is going to get trade deals outside the US, make themselves more resilient. What's going to happen is other countries are going to diversify their business chains and how they kind of work. And that is why I very strongly believe that the next couple of years is going to continue to see US underperformance. That's not about being bearish to the US, it's about relative performance.